Uh,
So Shantanu, I think on YouTube there are 68 and I can
Good
see
evening.
it live. Yeah.
Good evening, good morning, good afternoon, everyone. My name is Shantanu, and we are excited to have you join us today from across the globe. And we welcome you all for another session of Kotak Live. I'm extremely sorry for the inconvenience which was caused, and we are.
So Shantanu, I think on YouTube there are 68 and I can see it live. Yeah.
We will start the session in next 5 minutes. I'm extremely sorry for the delay.
Hi, Shantanu, can you see me and hear me? Radhika,
Yes, ma'am. I can.
my apologies about being late, some combo of tech issues here. I'm all
Uh,
set.
so we are live now, so we'll start the session.
Yes, perfect, perfect.
Okay. So, good evening, participants. So, I'm again extremely sorry for the inconvenience which is caused, and we are having a delayed start of around 12 minutes. So, let me start this again. So, this is a platform where we bring the experts to share their thoughts on the important points that impact the NRI clients. Our guest today is a renowned name in the industry who actually does not need any introduction, Miss Radhika Gupta. Radhika is an MD CEO of Edelweiss Mutual Fund. She leads one of the India's fastest asset managers. Under her, the AUM of Edelweiss has scaled from 6,500 crores in 2017 to around 1.5 lakh crores in 2025. A graduate of the prestigious Jerome Fisher program at the University of Pennsylvania. She also is a hedge fund manager, entrepreneur, public speaker, and a best-selling author, recognized by Forbes, Fortune, and Business Today amongst India's most powerful women in business, and also honored as a young global leader by the World Economic Forum. She is also widely known for her role as a judge on Shark Tank India season 3. Her insights on leadership, resilience, and financial wisdoms has inspired millions. So, welcome, Radhika. It's a pleasure to have you on this forum with our NRI clients. So, equity markets over the past few quarters has acted like a seesaw rides, and our client wants to hear your views on the thoughts on a few topics like what is the current market outlook, your views on gold and silver, what are the global factors that are impacting our markets, and what is the way forward for our Indian markets. Over to you, ma'am.
Thank you, Shantanu, and thank you to the entire Kotak team. I do a lot of these conversations, but I especially enjoy talking to folks who are NRIs, folks who live outside India. Because less known fact, for 20 years of my life, I've been an NRI, or actually more than 25 years of my life, I've lived outside the country, always had a keen interest in India and investing in India. But there is a different lens that you look at when you are in that situation. I know that there is a lot to talk about. So what I thought we could do is I have a few slides that just give you some perspective on the Indian equity market. I think I would divide this session into three halves. One is talking a little bit about Indian equities. I'll try to answer some of the questions that you had in terms of market outlook, etc. If there's anything that gets missed, then of course we can cover it in the Q&A. I think the second thing I thought would be worth talking about was solutions for NRIs, because market being what market is, I think as finally as investors, we all look for solutions to our problems and investing solutions. So from an Edelweiss mutual fund lens, I'm happy to talk about that. So we can do that for the next 20-30 minutes. And then of course, let's keep this interactive. So I'm sure you guys have lots of questions. Let's try and answer as many questions as we can. I am going to just take half a second to try and share my screen. And if you
Sure,
can
ma'am.
confirm that my screen is visible, then we can get started. Is my screen visible?
It's loading, ma'am.
It's
It's
loading. So once
Yes, ma'am. It's live now.
visible, one
It's
second.
visible.
I am also just trying to make this document full screen. There we go. Yeah, I think that should be good. So I
Yes.
think we're visible and good to go. So as I said, section one, I think just starts by giving you a little bit of thought on how Indian equities have shaped up. And before I do this, I must tell you a funny disclaimer. It's been, I think, since the Trump presidency really started about 18 odd months ago. We've been in such a news-driven environment. I do these presentations on a lighter note, and we make the content, and then you have an announcement on Friday night that completely changes everything that was said about the trade deal. So I think it has never been a period where we've seen this kind of flux geopolitically. And in fact, if you ask me, over the last 18 months, while investors have felt a lot of flux, the fact that benchmark indices are actually positive or not down in the last 18 months actually is a great statement of resilience for the markets. And I'll share some numbers with you later. But we come off an extremely volatile market. And I think here is some interesting context to set the tone in that background of volatility. So we did a quick analysis because investors have, of course, been feeling the heat of volatility. And if we look at the market on a 1 year basis, does it trend up? Does it trend down? Or does it move sideways? So, the analysis is done since 1979. So very, very long enough data set. Anything that's more than 6% return is trending up, less than 6% is down, and the rest is really sideways. And we're looking at 1 year returns. And what you see, which, sometimes investors are surprised to see, is actually 65% of the time, India is a market that has trended up. If you want to look at this from and 18% of the time is sideways. So actually, you're dealing with a negative market condition only about 20% of the time. And actually, if you look at the data of India versus the rest of the world, in most calendar years, pre and post COVID, we are one of the best performing equity markets. The last 18 months, I would say, have been a bit of an exception. And we are the second best performing equity market over any kind of long term history. The best performing market, of course, being the United States. But the point here is that really markets rise more than they fall. This, I think, is to what I was saying here, which is that actually, if you look at the last time, and this is a calendar year view on Indian equity markets over the last decade. So we're looking at the returns of the market over the last decade. There's a second part is to the breakup of the returns, which I'll talk about a little later. But if you look at the last time Indian equities had a very meaningful correction, can you guess what calendar year that was? It was actually 2013. 2013 was the last time you had a meaningful correction in India where you could go back and say the market has corrected and I have time to really position my bets and, jump in. So I also know a lot of investors, when they look at investing in India, wonder about valuations. We can talk about that. They wait for a correction, but actually you haven't seen large calendar year corrections for a considerably long time. Now, the second part to this is, what is really the source of return? Where are these returns coming from? And I think that is really the linchpin. So if you look at the total return of the index, there are two parts to it, actually three parts to it. One is a price-based return and one is a dividend-based return. And in India, of course, dividend yields are small. So price-based returns are really the driver. Price-based returns actually again can be divided into two things. And this will tie into what I'm going to share later. There is a return that comes from earnings growth of stock, so from profitability of underlying companies growing. And there is a return that comes from the re-rating of markets or the multiple of the market growing. If you actually, and I don't have it here, look at the composition of where the returns are coming from within the price-based return, the largest source of stock market return is actually earnings growth. And all of this I'm saying is this should give you comfort, because finally, if there is positive return that is happening, it's happening because the profitability of corporate India, earnings growth of corporate India is actually real. Now, I think the other thing that one should think about is, and I've been an observer now, an investor in India for at least 15 odd years, is Indian macros today have never looked more comfortable. And I would highlight just a few here. If you look at inflation levels in India, they never spiked to historical levels even after COVID, unlike the rest of the world. And if you look at CPI inflation today, it's actually very, very at controllable levels. And this is important because in terms of interest rates, it gives RBI a lot of maneuvering room. A second one to think about is credit growth. And, this will reflect in our sectoral view, which we'll talk about in a bit. But after a slowdown in credit growth, we also started to see credit growth in India pick up. And the third, I would say, is manufacturing PMI, which continues to remain very healthy and steady. So, from a macro point of view, India has perhaps never looked as good and comfortable. Now, this is the point I was making on where the market return comes from. And I think if there is one thing that all of you should care about, and only one thing that everyone should care about, it is this: it is corporate profitability. Um, if there is a single driver of market returns, it has to be corporate profitability in the Indian context. And in the period after COVID, when we saw Indian markets do exceptionally well, it was a period where you were seeing serious corporate profitability pick up. We saw a dip in that in FY25, some outcome of post-election, some outcome of a global slowdown. But in my view, a number of measures were taken last year on both direct tax, indirect tax, and interest rate cut. And you will start to see those measures playing out. Actually, you're already starting to see some of those measures play out. If you look at the results in India from a quarter three point of view, also, you're starting to see consumption come back, you're starting to see earnings come back. And if we continue to go back to mid-teens kind of earnings growth, then I think you have an opportunity for the next leg of really market growth to happen. Uh, this is the point I was making here earlier. But if you look at the driver of market returns, it actually continues to be earnings growth. So if you look at the chart on the left, it shows the contribution that is coming from two components. The dark blue line is from earnings per share, and the light blue line is from expansion of valuation or multiple growth. What you will see is in the last few years, and especially in the post-COVID period, market returns are hardly coming from earnings expansion. Market returns are hardly coming from PE growth. The largest driver is actually earnings expansion. And in my view, that is going to continue to be the case because there's not that much room from an Indian market point of view for PE growth to happen. So if there's going to be a driver of market returns, it continues to be earnings expansion. Keep in mind, this was not the case, if we go back a decade or 2 decades ago, where multiple expansion was also a source of returns. And, again, the chart on the left, if you look at period wise, the kind of growth that is coming on the index level and compare it to GDP growth, they are actually very, very nicely aligned. So there's no mystery actually behind these returns. I think one thing I would point out is a key part of India's economy continues, and many of you will have questions on sectors. But I do think consumption continues to be a very significant driver of the Indian economy and will continue to be a very significant driver of the Indian economy. And I just want to take a couple of minutes to highlight why. One is, if you look at India's trajectory, we are probably from a demographic point of view where China was about 15 years ago. Our demographic dividend started in about 2018, and in my view should continue until 2040. So 60% of our population is young, and that will drive a lot of different patterns. It will drive the way you consume, it will drive financialization, it will drive credit growth. So demographics are real. The second element is rising per capita income. Over the next decade, per capita income should double. Now, per capita income in India is about $3,000, and it's moving towards the $5,000 trajectory. This is a point, and China went through this evolution, when your basic needs, जिसको हम रोटी कपड़ा मकान कहते हैं, this start getting done, and then your discretionary spending increases. And again, this has implications on sectors, whether it is capital markets, whether it's hotel spending, which is, by the way, a sector I'm extremely excited about, whether it's dining out. The third is you will see an explosion. Some of this was reflected in the budget also, of urbanization. And urbanization will not be, this is perspective that often when you don't live in the country, you don't see. But India, I think, is not limited to Bombay, Delhi, Bangalore in terms of opportunity and spend. I would argue it's not even limited to Ahmedabad and Indore, which is what we would call tier two cities. There is now an explosion that is going to happen even across your tier three and tier four cities. Um, Fourth mega trend would be the whole emergence of digitization, which really ties into urbanization. I think whether it is access to a mutual fund or whether it is access to any kind of code, digitization is making things available on their fingertips. We have a listed company called Grow, which is the largest financial services, largest seller of SIPs in India today. Most people think Grow's SIPs come from a Mumbai or a Delhi. Actually, 60% of Agra's SIPs, a city like Agra in UP, happen through a platform like Grow. Uh, Fifth one is easy credit availability. Try going to a airport lounge in India. It's impossible to get in because people have so many credit cards and they stand at the beginning of the airport with a suite of credit cards saying which one can get in. But India has traditionally been an under-leveraged country at a household level, and there's an opportunity for the credit cycle to play off, and you're starting to see that. And I think the sixth one is premiumization. Again, very, very important trend that is happening, wherein everything from real estate to QSR to even your street shopping morphing into a Zudio shopping experience, the customer is choosing premium. So consumption, we think, is going to be one of the most important tailwinds for equity markets because there are so many fundamental drivers behind consumption. Um, and as I said, a number of measures were taken last year in terms of driving commission. Again, just to highlight a few, GST on a number of goods has got substantially cheaper. You're already starting to see the impact in some sectors called auto. The amount of direct tax benefit that was provided in February's budget, income up to 12 lakh now is effectively tax free, which is 1 lakh crore in tax relief that has been given. And of course, the interest rate cut has made a lot of discretionary purchases cheaper. One thing to keep in mind from a market point of view is come this year, you also have the eighth pay commission, which is going to benefit 11 million government employees, and the impact of that is also going to start to be visible. So consumption and a lot of fundamental drivers to benefit consumption. By the way, I don't know if we'll end up talking about the budget. Because so much was done last year in terms of pushing consumption, you had one of the most boring budgets this year because, quite frankly, there was not very much to do. Um, since you mentioned gold and silver, I should come to this. And I think if I had to wrap up this section on equity markets, uh, there is only one thing I would say. We've learned that asset allocation is the key. Now, this is a simple chart. What it does is it shows you a perspective of different asset classes in the long term. And of course, if you look at 2024, for instance, US equities have been a star. If you look at 2025, everyone was talking about silver, even including my parent-teacher meeting. But the reality is nobody can predict where this goes. I think my one advice to NRIs and to domestic investors, frankly, is don't try to predict, try to prepare. Build multi-asset portfolios. Now, again, from an NRI perspective, a little bit of this depends. Depending on where you are living in, you probably will have US equity or China equity or some of this as part of your portfolio. Of course, India equity should be a very meaningful part of your portfolio. And precious metals, I think, in some form, you should have exposure to. My only point on precious metals, since Shantanu asked me the question here, is precious metals play the role of insurance in your portfolio. In the long term, they are not a wealth creating asset class. If you look at the long term dollar returns of gold, which is relevant to many of you, uh, they are good, but they are not extraordinary. Uh, Within precious metals, silver is extremely volatile. I don't have this chart here, but look at a history of silver from 1970 to present. It'll deliver 160% return in a year, and then it'll not do anything for the next 8 years. So our approach on precious metals is this is insurance. You should have some insurance in your portfolio. But if you insure yourself for more than your home value, it doesn't make a lot of sense. So keep it as part of your asset allocation. If you're looking at gold, silver, we highly recommend blended products that combine the stability of gold and the volatility of silver. For instance, we run a gold and silver 50-50 fund, but keep this as a part of your asset allocation. When silver starts to play the role of mid cap in your portfolio, then I think you're too overloaded on silver. Um, and what I'm going to do now is, if you, yes, let's see that. I want to move to the second part of the session and really just talk a little bit about us. The idea is actually less to talk about Edelweiss, but more to talk about solutions and investing and how to think about some specific opportunities that could be relevant to NRI clients, how we are thinking about picking companies in the kind of environment that we are in, and of course, a little bit about us. So, of course, I represent Edelweiss Asset Management. We are one of the top 15 asset managers in the country. And today we really manage about, a quarter to 2 lakh odd crores across multiple asset classes, equity, debt, fixed income, commodities. We also offer international funds through our platform, and we really provide people access to anything that you would want as an Indian investor. We've been one of the fastest growing asset managers in the country, and we really serve customers across the length and breadth of India. So that's who we are. I think at the heart of any asset management firm is the people who run it. And I would say we have three capabilities with which we can work with you as asset managers. One is a capability around fundamental investing, and this powers our traditional equity funds, mid cap, small cap, large and mid cap, flexi cap, etc. The second is a capability around factor, quantitative, and more new age around investing. Here we provide a range of solutions on the hybrid side. We also provide a range of mid-risk and low-risk products that I'd be happy to talk about on the specialized investment fund side. And we have perhaps the oldest team in the industry running this business. And the third capability is fixed income. And this is essentially, I think, the universe of investment opportunities that is really out there from an India perspective. You have access to active strategies across equity and fixed income. You have access to multi-asset strategies, which are a very interesting category. You have access to the whole domain of passive strategies. You have international funds. You have for NRIs, I think, a very relevant class, solutions via Gift City, both to invest in India and to invest outside from India. And you have this new category of specialized investment funds that SEBI has created, where you can come up with some very, very specific solutions that I'm going to talk about. And we today, as an asset manager, are really present on all the platforms out there. I think this is something that I would highlight again from an NRI perspective. As an NRI, investing in India is part of what you do. But of course, there is an entire life that you live outside the country. And I know it is a very, very busy life. We like to, as an asset manager, add less drama to your life. One of our core principles is that funds should be run with a lot of consistency. We don't like to run, I know investors are obsessed with returns, and long-term returns are important. But we believe that if you deliver consistency in the short term, funds that are quartile one, quartile two also in the short term, without having too much drama, the long-term performance of all your funds will be very good. So for instance, one of our largest equity funds is Edelweiss Mid Cap Fund. It's never top of the charts in the short term. I'll tell you, it never hits rank one in any short period of time. But 90% of the time on a 3-year basis, it's quartile one or quartile two. 95% of the time on a 5-year basis, it is quartile one or quartile two. And, again, as someone who's been a fellow NRI, I highly recommend that all of you look at consistency and stability when you look at allocating to your India funds, Edelweiss or otherwise, because consistency and stability is really what gives you long-term performance. And if you're investing in Indian equities, the story really has to be long-term. I think in terms of investment philosophy, what we have found investing in India and what the source of consistency really is process. People come and go, but I think what stays is process. And for us, process has a few components. One is really not making mistakes. And the first part of our framework is spending a lot of time on forensic analysis of our companies to check the kind of accounting quality, board standards. Are they doing what they're saying? Are they treating minority shareholders fairly? The second is, of course, looking at businesses with an acceptable price framework. Now, we're happy to buy businesses that are undervalued relative to their valuation, or we're happy to buy businesses that show disproportionate growth, but there has to be a fair thinking about pricing. Robustness is very important. So We want businesses that are leaders, that are chasing scalable opportunities and that deliver return on capital metrics. And finally, the third one, which is very, very important, is we actually are agnostic to value or growth. We believe markets are very dynamic, sector cycles are very short. So we are not value investors, we are not growth investors. We actually look to find companies depending on market regimes. So we will have a combination of value and growth oriented companies in the portfolio. I think in terms of NRIs and my advice, as to the kind of funds you look at, and I'm sure we'll cover some of this in the Q&A. I have an old framework that says dal chawal. And I really think for NRIs, simple all-weather solutions work really, really well. If you're looking at equity funds, I genuinely recommend for India an approach that is very, very flexi cap or multi cap in nature. We have a tendency to either be extreme large cap or extreme small cap. We believe the juice is in holding a multi-cap portfolio. If you hold a purely large cap portfolio in India, you end up holding a portfolio that is banking, IT, and energy. And if you look at many of the themes of the Indian market, actually, the sectors that will represent the next decade, again, something we can talk about more, they're present in the mid-cap universe. So having a flavor of mid and small cap, either through mid-cap exposure or multi-cap exposure or flexi-cap exposure, we believe is very, very important. The other category we feel that is very, very powerful for investors from abroad is the whole hybrid category. There is a suite of funds like a balanced advantage, which is broadly 60-40 equity debt, or an aggressive hybrid or an equity savings that can give you exposure to India, but with some component of fixed income and incredible tax efficiency. So we think this category is great for conservative investors. It's great for retirees looking at India as a solution. So that's one thing I'd recommend. The second thing I would recommend is for investors who are looking to park capital in India, but looking for better tax efficient returns from fixed income, to look at this whole category of SIF. I'm not going to spend too much time on it today, but essentially it's a category between PMS and AIF and mutual funds. It's a mutual fund with the ability for the fund manager to do more. And what we are really trying to do here is combine safe strategies like arbitrage and fixed income with a few enhancements on derivatives to perhaps deliver you a 10% pre-tax return without too much volatility. So if you're looking at safety, then I think this category becomes a very, very powerful category. Um, and the last one is, I think Gift City is a very, very meaningful opportunity for NRI customers. Some of you may be investing in India in the rupee format through mutual funds, and that is all well and good. But I think Gift City lets you interact with India without touching and filing and doing a lot of things that are in India. In particular, I think what we're offering on the inbound side for NRIs who want to touch India and invest in Indian equities is very powerful. And it is perhaps the first fund in the industry that is doing this. We know that, and I think my screen has, okay. Okay. So we know that when you invest in India, you don't want to invest with a single asset manager. You want a portfolio that reflects multiple AMC styles, and you want a blend of funds. So in the Edelweiss India multi-manager equity fund, what we've tried to create is multiple opportunities within a single fund. When you invest $150,000 in the fund, you get a 60% flexi cap, 40% mid cap portfolio. Um, Four funds in each. One each is an Edelweiss fund. The balance are funds from the top 15 asset managers in India that we have chosen basis the performance. For you, it is one solution, one set of documentation, but access to a diversified basket of amazing flexi cap and mid cap funds. And the rebalancing is completely tax free in the gift structure because of the way we've set it up. So I think the point is, and this didn't exist when I was investing from overseas, there's a way to get complete India equity exposure in a single fund. So that is what is out there. A bunch of solutions in India, low risk solutions via SIF, NRI friendly solutions via gift. and would be happy to now stop and take any questions that you guys have. It's been great talking to you, and thank you to the Kotak team for doing this. I'm going to stop sharing my screen, and then we can move to questions. The screen share should have been stopped.
Thank you, ma'am. Thank you for sharing your insight and perspective on the Indian markets and sharing what are the different solutions which can benefit our NRI clients, not only in India, but also in Gift City. And in fact, you have answered most of the questions that we have received in the chat box with your presentations. But there's still a few questions which I will like to hear your views on.
Absolutely.
Like you talked about asset allocation. So, what should be an ideal asset allocations in these market scenarios? Say for a growth customer, say who must be in his 40s to 50s,
Uh-huh.
and for a conservative kind of investors, say retirees kind of investors.
Sure. So, firstly, I will give you answers to this, but I always feel that asset allocation is a conversation that a customer should have with people like you. I think the advisor or partner that you work with plays a real role in asset allocation, because finally it is extremely personalized, and each person has a sort of different risk appetite and different circumstances. So I'd highly recommend you have that conversation, not just with me, but with people like you. I think for a growth oriented investor, look, and let me just stick to India asset allocation, because I'm going to keep out international funds from this, because in different markets, you will be investing differently. So I'm going to keep that out. But ideally, for an aggressive investor, 60 to 65% equity is a nice place to be. 10 to 20% can be commodity allocation, and the balance can be fixed income asset allocation. Now, within the 55 to 60% equity, again, I would highly recommend a mix of large, mid, and small exposure. If you don't want to touch small, maybe you don't have to do that. But definitely large and mid cap exposure. I would caution you against building a 60% large cap portfolio. I think what we've done with the NRI solution, which is 60% flexi, 40% mid, actually is a very, very good point on asset allocation, because you will create a 50-50 portfolio, which will give you access to the top 250 companies. I think that's a great starting point. For a more conservative investor, for a retiree, I think you don't need to shift the commodity exposure. That can be 10-15%, but your equity exposure could perhaps come down to as low as 40%. I just want to make a point on retirees, because I think there is a lot of myth around retirement. I have both retired parents and in-laws. A lot of retirees start retirement at the age of 60. Um, Today, life expectancy in most parts of the world is 80, 85, 90. We spend one third of our life in retirement. And that means very frequently we have at least a 10, often 20, 25-year horizon. So my caution to retirees is you can be conservative, uh, but don't err on being too conservative. I think gone is the era when retirees were only sitting in deposits and safe instruments, because they just have that much more time. The other thing that retirees and senior investors can do is they can build portfolios using a lot of the hybrid funds I suggested. Um, One reason is those funds are fundamentally less volatile. And once you've given them a few years, if you have retired and you need quarterly regular income, for instance, those funds can start giving you that via SWP in a reasonably tax efficient.
Thanks, ma'am. So we move on to our next question. That what are the sectors to look out for in India for next 2 to 3 years perspective?
Okay. So again, I always hesitate to answer anything with a 2 to 3 year perspective, and I will give you our sector view. But I will also tell you our sector view changes, and it changes quickly as a fund house, because we believe market cycles are short. For instance, we were extremely bullish on IT 18 months ago, and you would have listened to me and said that currently, for the last 3 months, our portfolios have been underweight IT, and largely for good reasons. So I'll give you a viewpoint on where we think things could land. But generally, for investors, if you're going to listen to this and buy sector funds, please do it with caution and do it in a limited amount in your portfolios, because people buy sector funds, but they struggle to exit them. So they should be a small part of your portfolio. Now, in our portfolio, I think two sectors that we are structurally overweight. One is the whole consumption landscape. I talked a little bit about the drivers and catalysts for consumption, but I think there are three parts of consumption. There is core staples consumption, your FMCG, etc., that we've been moderate on. There is emerging themes of consumption, discretionary consumption, quick commerce, all of that, that we are very optimistic on. And then there are cyclical elements of consumption. And I'm talking about how we run our own consumption fund, where you have sectors that do well cyclically. But consumption, particularly discretionary consumption, we tend to be overweight on. The second sector that we are overweight on, we just launched a fund in this space, is the whole theme of financial services. Now, again, I could break financials into two parts, cyclical and structural. Structurally, the sector we are very overweight on is capital markets. We come from capital markets, you come from capital markets, but we think financialization is here to stay in India. Whether you look at penetration of credit cards, mutual funds, um, equities, demats, things have grown, but they are still very, very small. Mutual fund penetration is still about 18% of our GDP versus 80-90% in the rest of the world. So all capital market companies, we are structurally overweight on, and you're already seeing the momentum. The second part of financials is lenders, banks and NBFCs. They have been a sector that has been a laggard in the market. It's been one sector that's not performed, but we do believe credit growth is starting to come back in India, and that's when you will see lenders do well. So financials. Within these, by the way, there are, of course, micro sectors, and this is just for interest, that we think will be very, very interesting. Capital markets, I would say, is a micro sector that we're very interested in. I'll give you two more micro sectors that we are very interested in, and this also reflects my point on the mid cap index. So one micro sector is hotels. Outside of Bombay, Delhi, Bangalore, there is not enough hotel capacity in India. If you go to a city like Surat, there is one five-star hotel. When I go there for work, I have to give my resume to get a hotel room because there is just no capacity. And God help if there is a wedding going on. Kanpur, again, very large city in UP, does not have a single five-star hotel till date. Imagine. And this is true of many, many cities. So if you look at our hotel capacity to population, we are 1/10 of the US, 1/5 of China. And tourism spend is real. The second sector, which is related but opposite, is actually hospitals. Everyone wants an upgrade in quality of life. Healthcare costs are rising, and nobody wants to go to a government hospital anymore. We just don't have enough beds for the population. So, hotels and hospitals.
Okay, ma'am. Thank you. Thank you for the detailed answer. Now, I'll use one of your famous quote where you have said that the essence of wealth creation lies in consistency and patience. So, if you see our domestic investors in terms of consistency, at least on the SIP flow, say if I talk about from Jan 24 to Jan 26, the SIP flows have increased to around from 18K to around 31, 32K now, right? But what about the patience? Considering the markets have not moved in about last 1.5 years, so it is
Yeah.
actually testing the investors' patience. Like, so do you really think that we are in a time correction right now?
So, I would say, and I'll come to SIPs, given what we have seen in the last 18 months in India, um, a war with Pakistan, uh, a really turbulent relationship with the US that is now finding its ground with the trade deal, although Friday's events may change the relevance of the trade deal. Slowing down of earnings growth. I actually think the fact that markets have not corrected so much is incredible for investors. Now on SIP flows. So I think part of the SIP story is structural and a little bit is frothy. And let me break this up. The structural part is real. So I joined this industry in 2017, um, when India's SIP book was 4,000 crores. And people kept telling me market correct hoga, ye band ho jayega, ye hoga, wo hoga, all that stuff that you hear. We're sitting at 30,000 crores 8 years later, and no one could have forecasted that. Today, as I said, financialization is a real trend. People are aspirational. If you look at a first time job seeker and what they do with their first salary, they don't go and do an RD, which is a recurring deposit in the bank. They start by doing an SIP. So I think this is structural. And honestly, given the taxation structure in India, people don't have too many options. So I think this is structural. One of the reasons it's been resilient also is, I think, in SIPs, because there is value cost averaging, you don't lose too much money. So even in this turbulent period, actually, SIP investors have not done badly. Now there is a component that is frothy. So if you ask me, of this 30,000 crores, can growth slow down a little bit on SIPs? Will some SIPs get cancelled? Of course it will happen. Is 5% of the book going to be frothy? Yeah. But will this 30,000 come down to 20,000 overnight? I don't think that is the case. The good news for everyone is this. The SIP flow and the domestic flow is actually what has held up markets in the last 5 years, because you have seen 5 brutal years of FII outflows in India. And for interest, let me share some stats. In 2008, FIIs pulled out 40,000 crores from India. The market was down 50%. In COVID, they pulled out 80,000 crores. The market was down, I think, 30%. In the last year and a half, they pulled out more than a lakh and a half crores. Markets have been flat.
Okay. So let me move on to some of the questions that is coming to our YouTube live.
Sure.
Now, so it is similar to what I have asked you a few minutes back. So one of our investors wants to ask, aren't we in a time correction given INR is weakening against USD?
So yes, one has to look at this from a dollar perspective. Now, I have a perspective on INR that is a little less popular. If you look at historical depreciation of INR, it has been around 3.5-4%. I have no reason to believe that INR depreciation on a going forward basis is not going to be 2.5-3%. I think India will want to keep its currency at a certain level because of export competitiveness. By the way, the trade environment that we've had in the last 12-18 months has been extraordinarily tough uh, on exporters. So I think the RBI has also let this slide to give exporters some relief, although every time we hit 91, etc., things come down. I think what people have to look at is the adjusted long-term dollar returns of Indian equities, which in my view still look reasonably healthy. I think, yes, I mean, if 18 months of time correction, have we been in one? Perhaps yes, on a dollar adjusted basis, yes. But is a time correction a regular part of equity investing? Absolutely. I mean, a 30% correction is also a regular part of equity investing. So a time correction is also a part of equity investing. But I do think long-term dollar returns from Indian equities still look very compelling.
Okay, ma'am. Now comes to a recent update which has happened yesterday. That is where the US Supreme Court says the tariffs are illegal. So what does this mean for the Indian stock markets and other global markets?
So the real answer, I think, is being etched out. Uh, I think we made tremendous progress in signing the US India trade deal. And the good news, and my original presentation started with trade deal. And then, given everything that happened today morning, we had to change it. So that's the environment we live in. Uh, I think the good thing about, from an India perspective, all this tariff threat has been that it has motioned India into action. We are actually a country that responds very well when you push us against a wall. So we've done all the things on consumption that I said. We signed a fantastic trade deal with EU, by the way, that hopefully is unaffected by all this nonsense. And that really, I think, opens up opportunities. And today, 50% of our market is covered, our export market is covered by trade deals. Um, I think the market in general will react to what has happened on Friday positively. If you look at SGX Nifty, GIFT Nifty, early indicators, that's what it says. Because what it's going to come down to is the fact that tariffs are not well looked upon. There's this talk of this 10% most favored nation tariff now going on, which is substantially lower than what we have. But of course, Donald Trump is not someone who's going to lie down. So he has other, and if you look at the text of the speech, Justice Kavanaugh says the president has other options. So we will see what the other options are, but I think in aggregate markets will react positively. By the way, Donald Trump has also tweeted that nothing changes on the India-US trade deal.
Okay. So, ma'am, because of time constraint, I'll take one more questions that
Sure.
how are you discounting the AI?
Yeah. Another
Yes.
good question. Very good question. So I think AI for India is a bit of a mixed bag. And one of the reasons beyond global turbulence that we've been a less attractive market for FIIs over the last 18 months is India is not part of the AI story. We've been seen as an anti-AI trade, and to that, to now, and we're sitting and having this conversation at a time when you're having this huge AI summit and deals are being signed, and we'll see what will come out of it. Um, I think Indian IT will take some time to recalibrate. I told you we are underweight IT in the portfolios. By the way, I don't think Indian IT will die. I think that sector is incredibly resilient. It's very, very cash rich. It's very, very well run. It perhaps hasn't made the investments it should have made, uh, in technologies of the future. Um, but I think it will take time to recalibrate. Um, but I would not write off Indian IT, because if you had to write off Indian IT, then I would write off Indian consumption also, because IT is the biggest driver of consumption in India. It's also the biggest driver of financialization. It's a driver of a lot of things. So I think time will be taken to recalibrate. It is a challenging time because India is a country that is digitizing at a time when it needs to produce lakhs and lakhs of jobs. So I think jobs will continue to be a priority. We will take time to recalibrate. And the summit has shown that we now want to push the boundaries of AI. So hopefully it will also motion us into action. A short term, slightly negative view on IT services.
Okay. So, ladies and gentlemen, because of time constraint, we won't be able to take further questions now. Thank you once again, Radhika, for taking time out for this webinar for our NRI clients. And I'm sure many of the anxieties that the investors had would have been eased out with the confidence that you have shown in the Indian equity markets during this session.
Thank
Thank
you.
you.
Thank you so much. It was wonderful talking.